Dividend investors, bonjour. This is Mikey Hu, founder of Dividend.TO and passionate investor. I'm here with you today to help you invest with more conviction so you can enjoy your retirement. And speaking of which, when we invest for our retirement, we have to think for at least 20-25 years forward. We have to think about the future. And what better idea than investing in renewable energy for the future, right? 2020 has been very hard due to COVID-19. It has smashed the economy and it was difficult all across the world. In the US, electricity generation went down by 5%. The fuel generation went down by 10%. So basically, whenever there's a recession, whenever like this time we had even an economic lockdown, the entire economy shut down and reduced demand for power and for energy. But at the same time, renewable generation went up by 14%. What's happening now is a lot of countries are investing for the future. They have like very high net zero carbon targets, and they're pretty far away to reach them. So we can see that both in the US, the UK, India, China, pretty much all countries around the world are interested into investing into more renewable energy, get rid of coal, get rid of nuclear plants, because mostly they don't want to pollute anymore and they want to have like more efficient and better energy sources. One thing that has pushed countries to go even further is obviously the cost of generation. For decades, it cost a lot to generate power from solar or from wind energy. It was complicated, technology was not to par, and basically lots of countries were just like, yeah, you know what? We can't charge that much to our customers to consume energy, and for that reason, we're just gonna keep up with like cheap energy like coal or nuclear or gas. But this is changing a lot over the upcoming years. And we can already see probably like over the past 5 years, there was a huge interest from the stock market towards renewable stocks. Today, I'm going to present you 4 interesting picks in that sector, all diversified. Some are very concentrated, some are like across the world. So you can see that there's a lot to pick there. Those are part of my favorite one that pays dividend, obviously. So let's start with Brookfield Renewable. Now, first thing you have to understand is the Brookfield family is highly complicated. So we have renewable, infrastructures, properties, asset management. They're all managed by BAM Asset Management, right? And then they had this incredible, great idea to make it even more complex. So this year, Brookfield Renewable now has 4 tickers. So you have BEP and then BEP.UN.TO, which are limited trusts or limited partners, depending if you're US or Canadian. And they have created a corporation share class, which is BEPC or BEPC.TO if you're Canadian, pretty much for tax structure and also to be included into more ETFs and mutual funds. Those type of investments are easier for portfolio managers to buy, and this was the main reason. So there's not necessarily a big difference between the 2 tickers. They both track the same company. However, the dividend in your portfolio will be treated differently depending on the type of account or depending on the country you invest. So make sure that you do your own due diligence in regards to this part, because it could get a little bit complicated. So we're talking about a company that has been increasing its dividends since 2012, pays quarterly, decent yield, especially considering the nice run they had on the market. So the sentiment is very bullish toward Brookfield Renewable, but still, if you buy it today, you'll have a decent dividend at the same time. We're talking about a huge business. We're talking about hydroelectricity, wind, solar, distribution generation, and also storage. So basically, they do everything, and they're pretty much there across the world. So their main target is here in North America, but they're very active in South America and Europe as well. And you know what? Why not try to push Asia market at the same time? So when you look at Brookfield, you have something that is highly diversified in terms of source of power and also in terms of geography. So which is very good, because if you have a recession in a specific country, this company will be able to compensate with other energy sources in other countries. Now, in order to grow going forward, the company expects some margin expansion. They will obviously increase their rate as inflation goes by, and they have a strong development pipeline. Lots of utilities will have to invest billions of dollars into their project. They are capital intensive businesses, but that's what makes them so interesting for the future, because you know that they're generating lots of power today, but they're gonna be even bigger in the future. When you look at the payout ratio and how the ability of the company to pay out this dividend, you have to look at the funds from operations. So this is why Brookfield is talking about FFO per unit, and it targets 6 to 11% growth per year, which is very strong. And this will ensure that your dividend will not only be safe, but will continue to increase over time. In order to achieve such growth, they, as you can see, they focus a lot on solar energy. They want to grow their solar energy power generation by a lot, followed by wind and a little bit of hydroelectricity and a little bit of storage. But the bulk of the game for them will be solar energy for the upcoming years. In terms of geographic, they have a very interesting strategy, basically because they target pretty much all the world. So one quarter North America, another quarter Latin America, and then Asia and Europe, pretty much 25% of each of that 18,000 megawatt they want to produce, which is kind of like a lot of energy. If you pull out the stock chart on Brookfield Renewable, you will notice a dividend cut in 2020, which is not exactly a dividend cut, but this is happening because of there was that split with BEPC, and they have to adjust the number of shares and then the dividend. So there were no cuts. The dividend is still good, and holders of BEP receive shares of BEPC to compensate, so you don't have to worry about that. It's still growing at a very fast pace, and as you can see on the top of that chart, the stock price in US dollar went from 25 bucks to over 50 bucks over the past 2 years. So there's definitely a lot of interest from the market in that regard. When you look at the dividend and you isolate it alone, you can see the distribution is increasing by 6% on annual basis since 2012. This is pretty interesting because we're talking about a company that is growing a lot by investing into new projects, into acquisition, and developing a lots of energy power generation. At the same time, they find enough liquidity to invest in their shareholders and to reward them for their patience. So it's a great balance between stock appreciation potential and steady dividend growth. Now, finally, look at their debt ratio. Brookfield seems to be in a very good position with a BBB plus investment grade. They have average of 14 years for their corporate debt. So this means that their duration, this means that they're very well settled. They won't be rushed to renew their debts or anything. And they can see things coming. And most importantly, they have over $3 billion in cash available liquidity. Never forget that even though the Brookfield family is quite complex, each of the Brookfield arm is also sponsored or supported by Brookfield Asset Management. So whenever one of the unit is in need of capital, there's always also a possibility where BAM decide to put more money into one or the other. Now moving on to Boralex, a little bit smaller, lower yield, and unfortunately management forgot to increase their dividend so far in 2020. So this is why we don't see any dividend growth. It was on a good roll before. We're going to see that in a moment. But right now you'll have to focus on stock price appreciation because the yield under 2%, not that interesting. Boralex is all about wind power generation, a little bit the opposite compared to Brookfield. So a little bit of solar, a little bit of hydro, but not too much. And most of its business is being done in Canada and France, a little bit in the US, but we're heavily concentrated in those two parts. The company shows a great balance between acquisition and organic growth. So they already have lots of projects going on. They can benefit from increasing the rates on those, and they also are very active in terms of acquisition, especially to grow offshore. So to be a little bit more precise, you can see that Boralex is counting on a strong pipeline. We're talking about 2,700 megawatts, mostly solar and wind project, and a little bit more on the growth path. So right now they're really focused on their pipeline, which is split between early stage, mid stage, and advanced stage, and then they have like other possibilities once those are completed, but this will only happen after 2023. At least you have a pretty good idea of where the company is going, so we're still planning on doing lots of solar and wind energy on this one. So in terms of dividend, what you see at Boralex is a very good streak of dividend increase since 2014, but don't get confused with this graph offered by the company. This is the total dividend paid and not the dividend per share. So this is why you can see that there's an increase between 2019 and 2020, but this is because they issued more they issued more shares, not because they increased their dividend. So the last increase happened in 2018, and since then nothing happened on that part. I guess management was too busy focusing on growth, which is not necessarily a bad thing, but if you look at having a paycheck that increase over time and a decent yield, Boralex will not likely be a good point for you. On the other side of things, Boralex offers a very decent, a very safe dividend with a payout ratio target between 40 to 60%. This is exactly where they're sitting right now, around 50% for 2020. So you don't have to worry about the fact that the company hasn't increased its dividend. It's not a sign that the company is not doing well. It's just a sign that they're using their cash flow to generate more growth within the business. Speaking of using cash, the company is using a lot of debts to finance their project, but there's a good balance between equity and debt, and most of it is very targeted to specific projects. So basically what they do is that they sit down at the table, they look at different projects, and then they decide, oh, you know what, we're going to invest into this company, into this project, and we'll need debt to make it happen. So far, they have done a good track record of growing and finalizing their projects on time. So hopefully that going forward, Boralex will find a little bit more cash to distribute to their shareholders, so it could be bring back on my personal radar. Now, if you want to have a company with a higher yield and a good dividend growth streak, well, you can look at Innergex. Innergex, 100% renewable energy, mostly hydro, wind, and solar. So we're talking about a company that is quite interesting. And if you look at this chart, actually, it's kind of funny because right there, it says that the dividend yields at 3.8, and I just put that it was at 2.8. The thing is, between June and the time of recording, which was November 2020, the stock price jumped by more than 30%. This, once again, telling you the market loves renewables, and it's going to be very hard to find a cheap one because everybody loves it and they just want to pour more money into renewable energy. So this is why the yield could fluctuate a lot over the next couple of years. Now, in terms of what they do, Innergex is doing a lot of wind energy, similar to Boralex, but a little bit more with hydroelectricity as well. They have a partnership with Hydro-Quebec from obviously Quebec in Canada. Most of their projects are being done in either Canada, USA, and France. A little bit of Chile, but not too much. So we're talking about some company that is highly concentrated in North America, strong partnership with Hydro-Quebec, as I just said, and this is where they found their most of their project that we'll see in the upcoming slides. So what I like about Innergex is their PPA, which is the purchasing power agreement, are on average for 14 years, almost 15 years. You have about a third of it that is actually over 20 years, which helps a lot to make sure the cash flow will come in the upcoming years, it's going to be a lot easier for them to manage their projects and to create other opportunities to grow, and they can count on that consistent cash flow coming in. Now, most of their cash flow will be used to fund project in Canada. As you can see, most of it is on wind energy. They have a strong focus over there, a little bit more for solar in the US, and then you have like one project in France and a little bit in Chile, but most of it will happen in Canada, and most of their project is targeting wind energy at the same time. In terms of dividend, well, we have a company that is increasing by 2 cents since 2016, so pretty stable, straightforward. We like that. Decent yield at 3%. That is also interesting. However, I am a bit concerned about their payout ratio. As of June 30th, 2020, the payout ratio was at 150%. Management redid their calculation, include drips and stuff like that, and they'd say, oh no, it's not really 150, it's more like 120. But then again, we're a lot higher than 100%. Does this mean that company will cut a dividend? I don't think so, because they're growing and they have to invest a lot in their projects to grow at the same time. So that is fine with me. The only problem is at one point in time, they might do like Boralex and then just forget about increasing their dividend for a few years, just until the company generates more money from upcoming projects in their pipeline. So just be aware of that. If you compare Boralex, Innergex to Brookfield Renewable, the last two are a little bit, Boralex and Innergex, sorry, are not exactly incredible strong dividend grower. They might have to stop their dividend growth at one point in time, while Brookfield Renewable is very solid on this aspect. So when you look at their debt profile, it looks a lot like Boralex in the sense where they use a mix of equity and debt, and they will tie their debt to their project. So it's pretty much the same way they work as Boralex does to finance their wind projects for the upcoming years. What you can see on your left is also that the long-term debt is relatively stable between 2018 and 2020, which is a good sign because the company is still growing, but they're not borrowing money like there's no tomorrow either. So overall, I would say that so far, Brookfield Renewable is my favorite, then Innergex, then Boralex. But I wanted to offer you a perspective on a very small play, highly volatile, but quite interesting. I actually once owned Polaris infrastructure. I sold it at a good profit. I'm still looking at it to maybe jump back in. Yield is incredible at 6.35, but they haven't increased their dividend over the past 2 years, so that's a bit of a bummer. However, the company is quite interesting because they focus in Latin America. For a while, they only had a geothermal plant in Nicaragua, in San Jacinto, I guess. Sorry about that. But they recently did 2 new projects, hydroelectricity projects in Peru. So now they have like 3 central overall generating power, which is a little bit more diversified and should help them with consistent cash flow. The advantage of the Nicaragua geothermal plant is that they have a contract for several years with the government. I know that over the past few years, it has been a little bit more difficult in terms of politics stability over there. However, people will still need power. So while the stock price dropped, and this is when I bought it, it was just a great occasion to put money back in. And now they're moving with a more diversified business model with a little bit more of Peru hydroelectricity, and they have other projects on the pipeline as well in the next 3 to 4 years to make it a little bit more diversified. So overall, as I said, if you look at the megawatts, we're talking about like projected 200 megawatts as compared to thousands that I've been discussing for the other 3 companies. So don't expect this one to become a major player and don't invest too much on it. But at the same time, it is interesting to benefit from a higher yield and potentially more volatility, but more stock prices appreciation at the same time. What is interesting also is they are doing what they said they were doing. So they aimed at increasing their cash flow with their projects in Peru, and it's actually what's happening right now, so which is a very good sign. I think that while the dividend has not been increased for a while, the dividend is quite safe at this time, and with the cash flow projection increasing by 8 to 10% per year, which is very interesting as well. So you can think that the dividend may be increased in the future. What you see here is they have increased it a few times since 2016, but then unfortunately since 2018 they kind of forgot to increase their dividend going forward. The stock price is highly volatile, as you can say. It is important to know that this company is paying its dividend in US dollars, not in Canadian. So what you see here is the US price. The Canadian price is higher, obviously, because of currency fluctuation, but it will still bounce up and down all the time because it's a very small business that you're talking here. Finally, in terms of long-term debts, you can see a spike happening in 2019, mostly because of their investment in Peru, obviously, and they're using their cash flow to pay down that debt. So there's a good equilibrium, a good balance between funding new projects for the next 3-4 years, paying down the debts, which I like because you don't want to have a utility that has too much debt on their plate, and finally rewarding shareholders. My bet is they will not increase their dividend going forward for another 2-3 years. They will probably use their extra cash flow to fund their projects, and then they will be able to look at increasing their dividend going forward. Overall, at 6%, it's a good risk, but then again, don't put all your retirement money on this one. It will be a little bit riskier than the others. This is why I put it at the end of the video, but still an interesting pick if you're looking for something a little bit spicier to get in your investment soup. Next video, we'll talk about our favorite Canadian utilities, and I will not do any overlap with those. So I have selected 4 other interesting Canadian utilities that will come up next week. So until next video, smash that like button, follow me on YouTube, and stay invested. Cheers.